Trade of the day, the trade. Claude analyzed, but didn't trigger. Today I sold an iron cash secured put. Trade details. Stock. IREN. Share price. $36.29. Strike, $28. Expiry, 7th of August. Premium received, 85 cents. 11 days to expiry. I then asked Claude to analyze the trade. Its analysis was excellent. It calculated around 22.8% out of the money. Break even at $27.15. Around 3% return on secured capital. Approximately 100% annualized if a trade like this could be repeated continuously. High implied volatility explained why the premium was unusually rich. Estimated the delta somewhere around 0.05 to 0.08. Every one of those observations was fair. If I'd shown this trade to almost any experienced options trader, I suspect I'd have received a very similar analysis. In fact, if I'd shown exactly the same trade to ChatGPT without any history of how I trade, it would probably have analyzed it the same way, because that's what the finished trade looked like. But something interesting happened during the conversation. Claude actually found my trigger. What surprised me most wasn't where we disagreed. It was where we agreed. Claude described exactly what it believed happened before I sold the put. A red day, a selling flush, buyers beginning to appear, the first green candle, selling pressure slowing. That wasn't an assumption. That was exactly what happened. Claude had identified my trigger correctly. Where we differed wasn't the trigger, it was what happened next. Where our thinking parted company. Claude treated the chart as the introduction. Then it analyzed the option. For me, the chart wasn't the introduction. The chart was the decision. Everything that followed was simply checking whether the option chain was offering acceptable terms. The option chain never told me to trade. It only answered one question. If I'm going to trade, is the market paying me enough? That is a completely different process. The chart decides whether a trade exists. The option chain decides whether the terms are acceptable. My trading process. I never begin with the option chain. I begin with the stock. Step 1. Only trade on a red day. No exceptions. Step 2. Wait for the selling flush. Not because I think I can predict the bottom, because I want evidence that panic is beginning to slow. I'm looking for heavy selling, buyers stepping in, at least one green candle, longer lower wicks, price beginning to stabilize. Only then do I even think about opening the option chain. Step 3. Now I look at premium. On most stocks, I'm comfortable receiving around 1% to 1.5% of strike price. Not because that's mathematically perfect, because over time I've become comfortable with that balance between premium and risk. Step 4. IREN isn't a normal stock. Its implied volatility is much higher than most names I trade. Many traders would respond by moving closer to the money to collect even more premium. I do the opposite. I keep extending the strike further and further down the chain until the premium starts looking like a normal stock again. I'm not chasing higher premium. I'm trying to make an unusually volatile stock produce a premium percentage that fits my normal comfort zone. That's exactly how I arrived at the $28 strike. Why I never looked at delta. Claude estimated the delta. It was probably right, but I never looked. Not because delta isn't useful, because looking at delta too early can cloud my judgment. If I open the option chain first and immediately see a higher premium at a higher delta, my brain starts negotiating. It's only a little closer. The premium is much better. The probability is still good. Without even noticing it, I'm no longer following the chart. I'm following the option chain. The chain has started influencing my decision. So I deliberately remove that temptation. I let the chart make every important decision first. Only then do I open the option chain. By that stage, the strike has almost chosen itself. Whatever the delta happens to be, that's simply where my process ended. Delta didn't make the decision. It described the decision I'd already made. The lesson. Claude wasn't wrong. Neither was I. We were simply answering different questions. Claude analyzed the finished option. I analyze the behavior of the market that produced the option trade. The difference may sound small. I don't think it is. One process starts with an option chain and asks, which contract should I sell? Mine starts with the chart and asks, does a trade exist today? Only after that question has been answered do I look at an option chain. For me, the trade begins on the chart. The option chain simply tells me whether the market is willing to pay my price. Herein and Tapas trades. The chart tells me whether to trade. The option chain tells me whether the terms are acceptable.